Good morning. Welcome back to the Retirement Report. I should pay attention. Okay, we've been talking about taxes in the 4 stages of retirement, and pre-retirement being one of those. So, Friday, this is one of those areas. It's like I said, it's a new complex world. It's a lot more difficult when it comes to planning. To do it on your own is a lot more difficult today because of all the different areas, and we talk about all these different topics. So in this one, just for today, one of the changes, think in terms of the kinds of taxes, the way your taxes are structured and the way the deductions and credits and the things you get prior to retirement. So let's talk a little bit about
I think there's a couple things. The tax code basically doesn't reward people for saving. It kind of feels almost like they're punishing people that have done what we think is the right way, right? Make sure you have enough money for retirement. Put aside money in the bank. But, if you pay tax on it, that's one thing. But deferring it, often at the time of retirement, it kind of comes back at you, because to continue the lifestyle you want, you may have to see if that works well in the tax code. Of course, the other thing is children have grown. You basically have no mortgage, hopefully, when you hit retirement. And nowadays, under the current, as Hank opened the show saying, we don't really itemize as much under this current tax code. So your charitable contributions, your mortgage interest, your property taxes, unless it's managed in the right way, and there is still ways of managing where still every other year, especially a large number of my clients are extremely giving individuals. So maybe they give $15,000, $20,000 a year, and that still doesn't kick them into itemizing. But if we do it on the even odd situation, so every even year they give more closer to 40,000, and then in the odd situation they don't really contribute as much, we can still play a little bit with the itemizing and property tax situation. But I was telling Hank even before the show, the other side of that is grandchildren and children having to come home because of a lifestyle change. Even when you hit retirement, you're thinking it's just me, my spouse, whatever, and boom, life happens, right?
Yeah.
And so preparing for those unexpected is one of the things Hank, I think, is actually really good at. Not to say he's not good at a lot of things, but I've seen the people come in and talk about their situations, and he's like, hey, no problem. We've kind of prepared for that. We've got this little fund here and this. And that's the kind of thing you want to take into account, is that the perfect retirement is most likely going to be the most unexpected retirement. So
one of the
preparing
things,
for that.
I've heard, it's been said that the boomers are the sandwich generation, because they're in that position where they're caring many times for, or helping at the very least, for aging parents. And at the same time, then they have kids coming back, and they're trying to, balance all of that. They've got their own lives. They're trying to help take care of their parents, and at the same time, maybe having to help their kids get launched or, relaunched into life. So there's a lot on the plate to deal with, and again, retirement, sometimes that can be very daunting when it comes to that kind of thing, and seeing that change. So when you're still working, the kinds of the way your deductions worked, as Friday was just saying, you're having mortgage interest maybe that you're writing off. Now the house is paid off. Now you're thinking in terms of differently when it comes to retirement. Social Security, what that's going to look like. Medicare, what that's going to look like. Long-term care, how do you deal with that issue? And when it comes to how you're paying for those medical expenses, no longer is it something that just is being provided by the employer. Now it's Medicare, and you're paying a Part B premium, a Part D premium, and maybe a Medicare supplement. And for a couple, you might be looking at somewhere between $550 to $600 a month. In premium costs, not counting still some out-of-pocket costs you're still going to have. How to balance all these things out. Again, it's a much more complex situation. Dealing with required minimum distributions when that time comes, and planning for them. So forward-looking, this was, as I mentioned earlier, it's not just about how much you're going to pay in tax this year. It's how can we minimize taxes over your lifetime. And sometimes that takes a longer view as far as planning. Today's world, when you've got a 12%, let's say if you're in a 12% bracket, maybe paying tax at 12% so that later you're not going to have to pay tax. So I think it's 2025 when the current tax code sunsets. One of the things, wouldn't it be nice then if those tax brackets go up, if you've already got that handled and you're not going to be paying that higher tax, but you're going to have minimized taxes, maybe through Roth conversion strategy. These are all things that gets into
I will jump in
analysis
that,
of it.
because a lot of people listening are still working, everyday individuals, and you may be sitting there going, well, I have a 401k and I just give to it every paycheck, And the question is, yes, there's a percentage that your employer may be matching, and therefore you definitely want to use the 3, 4, whatever the percentage is that goes into it. But also keep in mind, you might want to have a chat with this guy sitting next to me, because there's a strategy he uses all the time where maybe the difference, maybe you should be giving, maybe to meet your retirement goals, you need to be giving 6% or whatever. Maybe that other 3% could be going into a Roth, still keeping you in the 12% tax bracket, which you may not see at retirement. I mean, prior to this new law, you would have been paying a minimum of most likely 15%. So that saving of 3% over your lifetime could be huge savings that you might be wanting to look into. So it's really important to understand your particular situation and putting that plan in now instead of waiting until you're 59 and go and talk to them and say, oh, I'm retiring in 5 years. It may have missed the window.
Yeah, and this is where understanding, okay, so the problem, all right, as we're going to outline, as we've been talking about when it comes to taxes in retirement, is all the complexities that go with, like taxation on your Social Security benefits, required minimum distributions that are going to have to be taken, all the hidden tax penalties that can occur. If you miss an RM, a required minimum distribution, you could get hit with a 50% tax penalty. If you take money out too soon, a 10% tax penalty. And then, as I mentioned, that with you take out some money, as we used in our early example at the opening of the show, where a person's taking out money thinking, I'm in a 22% bracket, this one I'm going to be paying in tax, but it triggered more taxation of more of their Social Security benefits to become taxed, and all of a sudden that tax ended up going up considerably more than what they expected.
Yes.
All of this you have to plan for. So when it comes to that, let's take a look at this slide. In fact, we'll show it up there on this problem. This is where you get into, again, some of the things I was just talking about, the way taxes change, the hidden taxes and penalties. If you don't know these, then you're just setting yourself up to pay a lot more in tax than you would otherwise have to pay. All right, so let's see. That was one of the areas when it comes to getting into this tax planning piece. In fact, let me offer up to you. One of the things, Friday and I worked as a team a lot of times with our clients, because her expertise, I don't do tax planning. I don't do tax preparation. Right. I do tax planning.
There's a little tax planning, yeah.
Yeah, that part, because I have to be able to look forward and say, taxation of your benefits, taxation of your income. How can we minimize it? We have to have strategies to do that. But then I'll call someone like Friday, or in this situation, mostly always Friday, and I'll say, hey, can you run these taxes for me? Run a return and make sure I'm not triggering some of these hidden taxes that I know are there. Right. Now, I can work out what it's going to be on Social Security for the most part. Right. All right, and I can see when I'm triggering some things potentially. AMT, now I want to run and I want to be able to identify it. Yeah, AMT being one of those, alternative minimum tax. So, for the first 10 callers to my office, if you would like to have this team approach brought for you for your planning at no cost, just call my office at 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment, and we'll do up a free, comprehensive financial plan with everything. It's not just the tax piece. That's going to be an important part, though. And we'll bring Friday in to meet with you. If you have an accountant, that you're very comfortable with, I'll show you how we can work with your accountant and make sure that these same strategies are applied. If you don't have someone, we can bring Friday in to help with that. And this is a great time to just do, this is when the off season, so to speak. It's a great time for tax planning, for getting your ducks in a row. One of the things, investment analysis is a part of that. I can stress test your portfolio and show you what type of risk are in your portfolio now. When the market has been running so well for so long, and we're in the longest bull market in history, when even with the volatility that we've had in the last week and a half, 2 weeks, even with that, we're still up 17%. The market is up 17% year to date. How's your portfolio doing? How are you doing today? Do you know what's going to happen in the next bear market with your portfolio? Are you going to lose the way the market drops? If it drops 40 or 50, is that what you can expect? Ooh. Might you lose even more? Do you know? And we can stress test, we can show you that. There are measures for that, and we can basically, it's called standard deviation. It's a great way to show you what the volatility is there, and then share some strategies on how to reduce that. So if the market drops 40, 50, we cut your losses way more, so less than half that, let's say, depending on what your overall goals are. and you recover quite, twice as fast as well. So anyway, first 10 callers, 615-376-5325. And when you come in to see me, I will give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And we get into that. The third chapter is IRA Mastery, and we get into tax planning, and in particular when it comes to retirement accounts in that. All right. When it comes to planning, all right, we hit this. I'm going to try to keep going through because there's some things I want to get through for you. So we talked about the problem. Again, people often paying more in taxes. Now we're going to develop a solution.
I like this one.
We like that. All right. Marlene, if you've got that slide for me on developing a solution, we can pop that up there. And then we can talk about some of the solutions that we utilize. I mentioned one of them being Roth conversion strategies. So as you can see with this, because your tax exposure will change, and as we were just saying, all these, throughout this, this goes an example, pre-retirement, how you deal with tax planning at that time, in retirement, in particular the first stages of retirement, what it looks like then when you're starting to take money out of retirement accounts. Then you get to that stage where you're taking required minimum distributions. All of this is where you're getting into different types of planning strategies that are going to be employed. And then later in life, when you get up over age 80, I mean, what happens also? Typically, we start seeing health issues come up. Yeah. What's that going to look like when it comes to tax planning? Sometimes, if we want to look at a silver lining to that cloud, one of the things is we are going to have some deductions. We may have some medical expenses that we can deduct, and this can help us. Yeah, it might be able to itemize again. So this can help with regard to minimizing taxes, but also in converting taxable dollars into tax-deferred dollars, we'll say, into tax-free dollars. Right. And tax deferral is good. We want to take advantage of it. Tax-free, of course, is even better. And understanding how to do that is a big part of it. This was where Roth conversions again can come in, and how to identify these different accounts and make planning. I'll give you an example. If I see what you're doing now, okay, and I see that everything's in tax deferred, and then depending on your tax bracket, your income needs and the rest, we start developing a plan of how can we move some of that tax deferred into tax free. Right. Okay, if that's going to make sense for you, and we do a long-term projection of what the potential tax savings can be, and in that analysis then, if it is going to benefit you, then we start structuring that, putting that in place, so that then later in life, we've already dealt with the taxes, okay, before it's too late. Yeah. All right, we're getting an advanced strategy. All right, we're going to dive into some more here, but first we got to take another break. But join us here because we're going to be right back on the Retirement Report.